I can't stress enough that Peter Leeds has not wavered from his message since I've started following him in 2017. Today I can finally see the cliff that he identified long ago. It's not just that the Great American Debt Bomb is going to pop. There's other bubbles, other areas of irrational exuberance, a lot of frenzied activity that when one of these bubbles or over speculations reverses or pops, then that can affect a lot of other bubbles too. The main one is the debt bomb, which everyone watching this video knows is going to eventually get to the point where it explodes and ruins a lot of things financially. But until that point, we can all whistle past the graveyard and just ignore it or not pay attention to it and keep your eyes on Kardashians in the election. What are we talking about here? We're talking about the coming economic reckoning. Matter of time. If it's not here tomorrow, it'll be here the day after that. And if it's not here the day after that, it'll be the day after that. It's a matter of time. Whenever it gets here, it's here. And everything's going to shift from greed to fear. And how long does that transition take? It happens in a moment, in an instant. All of a sudden, everything goes from greed to fear. We've got one stock which is worth 11.7% of the entire GDP of the whole nation. One stock. And as you know, the world economy is slowing down. And this was manifested or illustrated by the fact that the other day oil prices dropped $5 when Israel said we're not going to strike Iran's oil reserves or oil refineries. You see the price of oil drop $5 a barrel or 5%, whatever it was. And that illustrates or exposes what the risk premium was, because they thought there might be an escalation of the war. So all of a sudden oil prices start building up, just like with gold. And when that threat goes away or is diminished, that risk premium diminishes pretty significantly. And that's what you saw when the price of oil dropped $5 a barrel. But as I explained in my recent oil glut video, there's going to be way too much oil. And oil goes from being something you use to being something that becomes a liability. When you have enough oil, and then you have a few extra million barrels of oil lying around, it starts to build up. It starts to become a problem. And there's external influences too, such as all the military conflicts around the world, and also what's going on with other global economies. If China falls apart, does that affect us? If Germany falls apart, Ireland's in recession, Canada's in recession, the United States is going to be in recession pretty soon. And when that happens, all the greed that you're seeing gets replaced by fear. And when any of these plates that are balancing on the waiter's tray topples, they're all going to topple. Which is why I said exactly this in a recent Peter Leeds newsletter. I believe we are in an irrationally exuberant market, which is devoid of fear, leaving only greed and complacency. Extensive borrowing and debt levels are the only thing keeping the nation moving. And when the Great American Debt Bomb pops, reality will be exposed like a vampire to sunlight. The financial world is going to look very different not too long in the future from now. And you're going to say, wow, look at how bad it got. I don't know, Peter, were there any signs? Well, yeah, there was a lot of signs, and I'll tell you about a few of them right now. And don't take my word for it. Listen to some of the people that I respect and listen to a lot. They're agreeing with me. They're agreeing with us. There's extremely overvalued stocks or bizarrely overvalued stocks according to many sources. This is from MSN. Stocks are extremely overvalued according to an indicator favored by Warren Buffett. But this is from MarketWatch, an article from Mark Hulbert. Any way you look at it, the stock market is dangerously overvalued now. Also, S&P 500 is almost as pricey as it was at the January 2022 bull market top. Based on the latest S&P 500 monthly data, the market is overvalued somewhere in the range of 103% to 170%, depending on the indicator, up from last month's 98% to 164% range. So it's dramatically overvalued and getting worse. I'm not sure where everyone else is assuming this is going to go or where this is leading, which reminds me of the most important comment that I've gotten in a long time that I definitely want to read to you, especially if you're new here. If you've been around here on the Peter Leeds YouTube channel for 6 months, a year or less, listen to this. I can't stress enough that Peter Leeds has not wavered from his message since I've started following him in 2017. Today I can finally see the cliff that he identified long ago. I've been talking about this forever, you guys, and I'm glad that everyone's seeing it now, but it's too late. We can't do anything about it. the economy is going to crumple and fall apart, and there will be a lot of harm and damage from that. There's nothing that's going to stop it. No elected official, no new philosophy among society. The debt bomb has gone beyond where it can be stopped. We're already paying over $1 trillion per year just to float the debt that we have, just to pay the interest charges on the government's credit card. Here's another one. Stock bulls are telling themselves a lot of lies about this market. And here we have U.S. market is extremely overvalued now by almost any measure. And this is from Finbold. Nvidia is now worth 11.7% of all American gross domestic product. 11.7% of the nation's GDP. And it goes on to say, will this be the next dot-com bubble? It'll be different in some ways, similar in some ways, but it's not ever going to be the next dot-com bubble. But that doesn't mean it's not going to act the same way. There's absolutely an overvaluation in stocks, which will revert to mean. It will go back to where it should be, more realistic valuations. However, we are in a moment of liquidity expansion. So as long as they're lowering interest rates and printing new money and doing quantitative easing, yeah, you can get the house prices, cryptocurrency prices, stock market prices to go through the roof. That's exactly what happened in Venezuela. Some people were billionaires and had no way of getting any kind of food or medicine. But the thing about all this easing and quantitative loosening, it's an artificial influence. And I tell you guys all the time, when something's artificial, it's always temporary. So if they say, we're going to lower rates and print money and make everything seem like it's going higher, make the stock market go higher because it's a manipulated market, it's not trading based on market discovery, it's trading based on governmental decisions. This is all temporary. It's all artificial, so it's temporary. And what happens when those influences pull back? That's where you get a backdraft. That's where you get an overreaction to the downside. I want to take you through this article from Advisor Perspectives. Is the stock market still overvalued? And they're using a lot of metrics here. That's what I wanted to show you. Because you got one of my favorites here, the Q ratio. Anytime it's over 1.0, but displayed here by 117% over 100%, that's a risk factor, and it always is followed, maybe not the next day, but it's always followed by a massive stock market correction. The stock market is like a pendulum where it overcorrects to the good side, which is what it's doing right now, and it overcorrects to the downside when it goes the other way. But they also look at a lot of other top-level valuation metrics or indicators. And what you're looking for, where the risk is anything over 100% for these numbers. This is the average of 4 valuation indicators. They explain in the article how they calculate these, but they're all the same thing. They're all telling the same story. When you look at overvaluation metrics and you combine them into one thing, this is what it looks like. And anything over 100, once you get up to these levels, is a definite overvaluation and risk scenario. Again, like I said, it's hard to go against the market at a time of quantitative easing and loosening and money creation and lowering interest rates. But as we'll get into in a bit, that's when recessions begin, when they're lowering rates. But I'll put a link to this article below this video and you can go and check it out yourself. Basically, however you look at it, from any metric, the markets are overvalued at the current levels. The S&P 500, for example, in the last year, it's already up over 40% over the year. And I tell you, it's not about the final destination, it's about the speed in which it gets there, the slope of the curve, the slope of the trend. It went up 40% in a year. That's too fast for the S&P 500. Even in a good economy, that would be too fast. It wouldn't be sustainable. It wouldn't be lasting. The faster something moves, the quicker it comes back down to earth. You want it to go up 40% over numerous years, and that way it'll hold those gains. These gains won't be held. Many of them will, but overall, there will be a reversion or a correction for a lot of these overvalued stocks, in my opinion. When is it going to happen? Maybe not soon. There's a quantitative easing situation right now where everything's going to be doing well. The stock market's going to be doing well. Cryptocurrencies will do well. Precious metals will do well. And no one's afraid anymore. Hey, after all, we've got the plunge protection team. And if things go badly, the Federal Reserve will just react and get everything to be good again. Everyone is completely oblivious of the danger because we haven't had any real danger in these markets in such a long time. And I'm not just talking about the stock market. I'm talking about the economy, and I'm talking about you. I do not trust this market at all. And the higher it goes, it's just going to be falling from a higher base. Is it going to fall tomorrow? I don't know. Is it going to fall? I believe it will. But the Federal Reserve, as I said, and the government are doing a lot of things that are artificial and therefore temporary to goose the numbers. They got the GDP numbers higher because they're buying weapons and they're hiring government workers, neither of which helps the economy at all, but both of which contribute to GDP. Well, let's talk about what you and I both know. We know that the debt levels are unsustainable. We know that the speed at which we're taking it on is accelerating. We know that we're in a situation that we have never, ever, ever been in. No society has ever been in the situation we're in right now with the level of debt we have at a time where we've been running an ongoing operating deficit every year since about 1970 or so. We understand that the debts are unpayable. Talking about the federal debt and a lot of what the government owes, what they put on the shoulders of U.S. taxpayers, but what is owed cannot be paid, and now it's admittedly not going to be paid. But technically it could be paid because they'll create new money, and therefore they're going to default through inflation. They create a whole bunch of money and pay off everything with these watered down dollars. Well, we've got $13 trillion in debt. Just make 13 trillion units. Make $1 trillion platinum coin, Janet Yellen. Make about 13 of those. Let's give them out and we're debt free. There will be a massive influx of new money into the system. The liquidity will spike. Everything's going to be seeming to be doing well, including inflation. Whenever the economic reality kicks in and then people realize, wait a minute, we were leaning too far towards greed and not far enough towards fear. And when they all correct, the Federal Reserve will react and overreact, just dumping money on everybody, as they always do, which will cause inflation in house prices, artwork, food, stocks, cryptocurrencies, precious metals. But the thing is, I put out a video recently about $10,000 gold, and we will get there. But I don't know that I want to see $10,000 gold because what that means, what it represents about what's going on with the economy. $10,000 gold in my mind is a lock, but it'll also mean that a lot of other things are a lock as well that are not good for the economies of the world and just for basic security of the world. But what we're finally seeing now is a global recognition of the failure of the US dollar. And also there's active players trying to get away from the US dollar, which includes all the BRICS nations, of which now there are more than 5. There's more like 12, I think. But what are we talking about here? There's a lot of areas of overvaluation, areas of risk right now that I feel like people aren't really keeping an eye on because they're all assuming that everything's going to be fine because things can be manipulated to make them better. I mean, after all, we're in an election cycle, so no one's going to let the stock market fall apart now. Okay, so give it a week. Election will be over, and if we have a clear winner of the election, then we can move on with our lives. But what I'm talking about is all these areas of overvaluation. One of them's going to pop. And when one of them pops, they can affect the other ones too. The main one is the confidence in the US dollar going away. That'll happen before the debt bomb catches up with us. The confidence will go first. Real estate doesn't make sense because it's at a level, price-wise, that it's not able for a new family getting started to be able to afford a home for a new family getting started. This will be temporary. Things like a real estate market adapts and changes where there's not enough houses. Houses become more expensive, so they build more houses. It's the same as anything. It's capitalism. It'll take care of itself. But this economic delusion that we're all in is going to pop too. We're having cheerleaders always coming out on the media saying, the American economy is so strong because of this, because of that. And they keep telling you. We think thou protestest too much. If it's a good economy, you don't need to talk about how good it is. I don't know if it'll happen early or a bit deeper into the process, but the wealth effect will diminish almost completely. Maybe not at first. There's a really strong wealth effect right now, especially if you own a house or if you own some of these stocks that have been doing well. But two things are almost certain in my mind. This is all opinion only, make your own decisions. I believe that stocks will come back down to realistic levels, much lower prices, and that the debt bomb that I've been talking about since 2017, based on the testimonial that came in from Fernando, but it's actually longer than that, is suddenly going to matter. And I'm not giving you timelines of when, I'm just telling you. When you see a train approaching that's going to hit you, it doesn't matter how far away it is. It matters how fast is it going. And now the great news is that we're finally starting to lower interest rates. But I can show you on this chart that when interest rates start to go lower, that's often where the recession, indicated by these gray areas on the chart, that's where the recession begins. So we've got rate reductions going into a likely recession. Real estate is unaffordable, unreasonable, unrealistic. And something I wanted to say about cryptocurrencies. In a market panic, they're going to come down too. They're going to suffer too. Just like industrial metals like silver. Silver will come down too. But don't think of cryptocurrencies as a safe haven just because the dollar is deteriorating. There's too much of a speculative involvement with cryptocurrencies in addition to its intrinsic value. So what do we have now? What do we do now? First of all, you got an election coming up in a few days. Wait till a few days after that. See what happens. It's going to change a lot of things. You don't want to make any major moves right now, in my opinion, unless it's defensively. But then a couple of days after the election, which is on Tuesday, we have a rate decision, which will be Thursday, from the Federal Reserve, lowering interest rates again. For nearly 3 decades now, I've written for the Peter Leeds newsletter. It's one of the most popular financial publications ever. And if you want to get our world-famous stock picks, just join the peterleeds.com newsletter. And if you don't want to pay the $200 for the newsletter, you could join for $3 a month to become a Peter Leeds Insider, which means you have direct access with me. You get a special newsletter and also a lot of other benefits too. If you want to join our group, just visit peterleeds.com/insiders.